Hey, welcome back to Two Super Guys Trade Stocks. I'm Dylan.
And I'm Vinny. And, there's a household company that is having a rough year. And the question is this a fallen angel, which is exactly my favorite kind of investing, or is this a value trap? So Dylan highlighted it for me. And then I'm going to show you kind of some of my little background and due diligence on UPS stock. We'll get to it.
I've
All
been
right.
looking forward to this for a while. I've asked Vinny to do this because it's like this is crazy low. So I want to know is this Intel or is this like Ford or is that $2 and now it's at 12 or 14 or whatever?
Yeah. Yeah, I mean it's a legitimate question. I've talked about before. I love fallen angels investing. When you see a well-run company that is like part of everyday life that all of a sudden has like something a little hiccup in their business and the stock just dramatically sells off, you have to wonder like is this justified or is it not? And then if it's not, buy a crap load of it.
Right.
Hence Meta, right, or Baba. Now you can say that that's like a winner. It's up 100% a year.
Boom.
Um, yeah, I know, right? So UPS stock down 32%, all right, year to date. That's pretty impressive when you're having positive GDP growth. The stock market itself is up like what was it 12% for the SPY. So it's a pretty solid year, and UPS is underperforming by a significant margin, despite the fact that they're a household name that many folks like have
Yeah.
contact with on a daily basis.
Agreed.
Yeah. All right. So this is from a website kind of looking at the overall shipping industry to see where they landed. This is just in terms of revenue, but basically the second largest one in the world. And there was like a significant drop off down to like the number three. But UPS and FedEx go hand in hand as far as one and two. You certainly could argue now that if you're looking at simply package volume rather than revenue from external customers, that Amazon would be probably up there in this realm. But here nor there, just to give you an idea of just how important they are to like everyday American life. So these are the other couple of quick things from CNBC's little snapshot on the company that certainly made me go like, oh wow, I should probably spend some time on this. One, look at this PE, 12. I mean that for a PE right now, where the SPY is what like over 25, somewhere in that ballpark as far as the market as
Yeah,
a whole.
like 26,
Um,
27, somewhere around there.
yeah, this is insanely low. The question is whether or not that's justified. The other thing that kind of gives me a little bit of pause though is this dividend yield, almost 8%. That's a big hairy number. We were talking about high yield savings, yielding 3.5%, and a 10-year Treasury bond yielding 4%. This stock is in theory right now listed at the current price, yielding double the 10-year Treasury yield.
Yeah, so that's a lot. Also, for anyone who is like me and is immediately Googling what the comparison is for FedEx, FedEx year to date is down 13%, while UPS is 33. So
Okay.
just in case people were wondering,
Yeah. Yeah. So like some kind
it's a
of quick
huge
highlights here as
dividend.
far as yeah.
That's massive.
Suspiciously large. We'll get to that kind of towards the end of the presentation. Um, revenue basically, obviously we had the pandemic boom and the revenue just took off like about out of hell as everyone was getting something shipped to their house. They've had some underperformance now since then. I mean, if you were to extend this trend line of where they were
Yeah.
pre-pandemic up, we're getting back to more of a normalized growth rate here. So they had a significant pull forward, and then they're kind of returning to like a more traditional positive growth pattern over time, if you will, where they would have should have been. Um, but you're going to see it from a quarterly basis. There was obviously a significant amount of fluctuation here, and even now, the most recent couple of quarters have been negative year over year. Operating income has been even a little bit worse. When you're talking about a business like UPS, their scale really is what makes them profitable, right? By having each and every one of their truckloads and kind of airplanes full to the maximum capability, means that that their marginal cost per package that they're moving is lower. So that's what is required for them to be a successful business. As revenue has started to decline, operating income has fallen off a cliff even more severely. All right,
Okay.
hence it.
Yeah.
Yeah.
Yeah. Jeez. All
One
right.
thing that this is a positive red one. Shares outstanding. This is something I always like to see declining over time. Now you get into a lot of nuance about when the timing occurred of these buybacks, whether or not it was done at a stock price that makes sense. We can get into that a little bit more nuance later, but it's still a sign that management does like to reward shareholders and do have a shareholder-minded mentality. Okay, so
It
that's a positive for me.
it does look like there's a little break before 2020 on share buybacks, and it looks like they kind of restarted in the 2023. You'd see the trend
Yeah,
start to go down again.
yeah, they actually did $1 billion in like the first half of this year already too.
Nice.
Um, and then in terms of historical multiples, where are they? Like, how cheap are they compared to what they've been in the past, when they haven't been facing kind of this post-pandemic kind of adjustment period, if you will. So I looked at the PE. Historically, I would say that the PE has been like the low teens to 20. So somewhere in the teen range throughout the majority of this time period. There's a couple blips here where one significantly higher. But they're at 12 and a half now. So they're on the lower end of their historical range, but they're not below it or in any sort of uncharted territory as far as their PE from a kind of valuation perspective.
Okay. All right. That's
All
not
right.
surprising.
Price to free cash flow. Similar kind of story here. Low teens to 20 as far as like the historical range. Obviously, there's another ridiculous blip here. But they're at 15 right now. So they're kind of right in the middle of their price to free cash flow historical price ratio. So not significantly undervalued from that perspective either. From
Okay.
their own
Wow.
perspective. Yeah. All right. So now I'm going to get into the most recent earnings presentation. This is for the second quarter of 2025. So this is an interesting one here, where management is basically just showing you like it's not great. Another thing that I kind of noticed looking at their earnings for the first time is they are all about the non-GAAP. Like they don't believe in GAAP whatsoever,
Okay.
which is
What are
tough
you?
because it's harder to standardize, right?
Yeah, there's less rigid requirements. What are your thoughts on that? Do you prefer GAAP or non?
I understand adjusting to non-GAAP numbers for certain aspects, but I just thought it gave me I don't really love it vibe because I thought it was too many of their kind of numbers were stated in non-GAAP measurements,
Yeah.
which is all that Waller telling that even on a non-GAAP basis, like look at how negative all of
Yeah.
these year-over-year changes are.
Not that you could fudge numbers, but you could make the picture look better using non-GAAP. And if they're still negative in that, not great. Yeah.
Yeah,
Okay.
definitely
Makes
more
sense.
fungible than Gap. All right.
More fudgeable.
They are on a kind of cost cutting pathway here. They're expecting to have $3.5 billion in savings this year. These are a couple like their key components there where they're closing some of their kind of buildings. I don't know if they in that as warehouses or UPS stores or what. I'm not really sure on that. But and they're also offering early retirement, and then they also increase the prices on their UPS Ground Saver. So trying to be a little bit more efficient, which is not necessarily a bad thing. This is certainly saw Meta have their year of efficiency, and we saw what happened after that, which was phenomenal for the company. You just have to kind of believe in management's ability to execute on that plan.
Yeah, I mean, if they follow Meta's plan, if they just put AI in the trucks for no reason, but they just talk about it on an earnings call, massive spike. You just
Yeah,
gotta say AI a couple times.
yeah, absolutely. So it's hard to have your revenue growing when the volume of packages that they're moving is declining 7% year over year. That's a pretty big number.
Okay, that's not great.
Yeah,
Not
yeah.
ideal.
This is by far and away the most worrisome slide in the presentation. I love that they laid it out so beautifully for us. But this is the biggest red flag I think I've seen in a while. So if you follow me here, right? Cash flow from operations, 2.7 billion. Free cash flow, because that means they had to do capex of about $2 billion. And then they paid somehow $2.7 billion in dividends and then bought back $1 billion in shares. So that means that they had to come up with an extra $3 billion somehow because it wasn't provided by the free cash flow that the business generated. Want to guess how they did that?
Uh, how?
We gotta go a couple more slides. Here we go. Yeah, right here. So this is from their balance sheet. They basically added $3.5 billion in debt in order to be able to
Ah,
pay those dividends
okay.
and
Come
buy back
on.
shares. So
The
the share
dividend's too
buyback
high,
is
man.
over for the year,
Yeah.
but the dividend is not. And the dividend will continue to go forward on it's like a $5 billion per year, $5.5 billion per year annual run rate.
That's crippling. That's too high. That's
Yeah.
absolutely too high.
So let me go back to this side here. Basically, another thing that they mentioned in their earnings presentation is that they're not going to give any forward-looking guidance, profit, and revenue. Too many things were uncertain. Right here, they do call out $3.5 billion in capex. So that quarter, most recently, was $2 billion. So that's a little bit above what they're expecting for the entire, more disproportionately large in the last quarter. So that probably under reflects what their true cash flow would be, their free cash flow on a quarterly basis. Just if I'm looking at just the most recent one. but then they have this $5.5 billion in dividend payouts, $1 billion that they've already done in share purchases, 1.4 billion in pensions, because don't forget, UPS is a legacy employer that has some pension obligations, and their tax rate of 23.5%. They're much less efficient than many of the mega cap tech companies, which is interesting. From a tax
Yeah,
rate perspective.
that's really high.
Yeah, we see like
All
Meta
right.
down to like 14%.
Yeah. What is
Yeah.
going
So,
on? That. Ugh.
so
Okay.
definitely scary. One of the things you look at here is that dividend payout ratio. So what portion of their profits do you want to see paid out? Typically, for it to be a healthy, safe dividends around 50%. This is the Google AI kind of summary here, saying that depending on where you look, it's 85 to 97% a range for UPS payout ratio, which is very, very, very high.
Yeah.
Sorry.
It's not sustainable at all. That's
No.
it's completely crippling their company.
Well, okay. So knowing that in reality a dividend cut is probably very likely to happen, um,
Yes, very
I wanted
likely.
to look at what historical performance looks like after dividend cuts. So I can't remember, it's dividend.com, I think is where the sources for this is. This is looking at the average annual returns over a 50-year period or 52-year period of the stock market. Now, companies that cut their dividend or eliminate a dividend, their return is almost negative 1% per year on average throughout that time period.
All right. You cut out there. Do you say so negative 0.89%?
Yeah, yeah. Is that not scary?
So, yeah, and I would assume it's usually that's after a recovery. So, because a lot of times when you get a dividend cut, there's like an immediate kind of a large drop. This is a year after that. So, that's mostly after it's recovered. So, I think what you're saying is they have to cut their dividend. And after that dividend cut, after there's a kind of a
Yeah,
substantial drop, that would be the time to go for this.
yeah.
If you were to go for it.
Exactly. And then, this is a even more
Oh, shoot.
startling in way.
Vinny.
Yeah, true. Yeah, but this chart right here just scared the living crap out of me though. Look at this. Over 50 years, basically, if you had a dividend cutting company, a dividend eliminating company, on average, your returns took $100 and turned it into $63.
Yeah, so that's not good. That's not good at all.
Yeah.
That's terrible.
Basically, we're looking at a dividend cut here, and this is a company that I wouldn't touch until after they actually do that. Is my summary on UPS stock.
Okay. Yeah, I mean that makes sense. I was excited to. There's a lot of people like on Reddit, a bunch of other YouTube channels are like, oh, this is the time to buy because they didn't do any financial analysis. They're just looking at the chart, comparing it to FedEx, and it's like, oh, well, they're the same company. It's very low.
No,
Yeah,
I agree.
I'm glad we looked at this because I do not want to. That dividend's disgusting, man.
Yeah, yeah. I mean, and we've seen what happens when companies get tied to their dividend, and unfortunately, it really limits management's ability to kind of pivot and make the appropriate changes for the business. So it is ultimately the right decision, I think, to cut the dividend, but it's gonna hurt them when they do it from a stock price perspective. So if you are interested in buying it, I'd probably wait until after that. But I am also the guy that said I would probably wait until United Health got down to like 250 a share and kind of missed that boat. So you
Yeah,
never know.
it still might. All right, guys.
Come on.
Let us know if you're gonna buy it. Probably not.
Yeah, catch you on the next one. Sorry about that little internet disturbance there.
All right, later, guys.